when I started the land business, got into it, it was a survival thing. So a little backstory about me is I worked in the rail industry from the time I was 22 up till 35, and then I had gotten to an executive level, and then one day it was gone.
Welcome, everybody. How's it going, Mason?
It's going great. Just recorded a fantastic episode that we're very excited for you guys to get to listen to. And yeah, that was one of the better conversations I feel like we've had on the show.
Yeah, absolutely. A lot of nuggets in there, things that I didn't know. And I think we both learned a lot kind of selfishly, and hopefully our audience will too. So all that to say, we had Justin Sliva on the show. Justin's been involved in over 600 real estate deals in 42 states. I think he actually updated that to 44 on the podcast, specializing in land. He's flipped properties from a $50 purchase price all the way to multiple seven figures. And he was previously in the rail industry, and he brought his experience there into reducing variability, risk, and streamlining processes to the land business. So he owns, or is part owner in Land Mule, Plum Investment Group, Casual Fridays Media Group, and Pasture Holdings, where he's doing land deals. He has a fund he's using and helping people earn interest on the land deals he's doing. He's flipping and developing a lot of rural subdivisions, and he's taught over 475 clients how to do the same. So he has quite the ecosystem he's built. And we had a great interview with him today. So let's bring him on.
All right, Justin, how are you doing?
Doing good, Mason. Thanks for having me, Dan. It's good to actually meet you.
Likewise.
Yeah, it's great to have you on the show. It was nice getting to meet you in person. I heard a lot about you from our first ever guest actually on the Big Picture Blueprint, which was Mr. Trevor Proban. I know you guys are business partners, but Justin, I really want to dive into you and your business and what all you've accomplished. So what is an ego-driven project or deal that you have done that you regret doing?
Ego-driven project or deal. Wow. So now you threw me off with the ego-driven added in there, because I don't know that I don't get too ego frame for ego on the business side, just because when I started the land business, got into it, it was a survival thing. So a little backstory about me is I worked in the rail industry from the time I was 22 up till 35. And then I had gotten to an executive level. And then one day it was gone. Like, my boss calls me in, says, "Hey, you no longer work here." And I'm like, "Why?" He said, "I don't have to tell you." And I said, "Well, I want to know." And he says, "I'm sorry, you'll do well wherever you go." And kind of that was the end of the conversation. I signed a separation agreement. They paid me to leave. And we had just started the land investing thing. We bought some coastal properties. We had just sent our first mailer out, and we bought 21 like cheap desert properties, and we were getting ready to, take on the world. This was my Lamborghini money and vacation money. And then I didn't have a job. So that's I say that because we all get into side hustles because we want that extra. We want that cool Rolex, or we want that nice vacation. We want that Instagram flashy lifestyle. And so for me, I had a really good job. I made really good money, and my career was doing great. And this was just that extra. Like, I get to buy the toy I want. Me and my wife are going to go on vacations. My kids going to get whatever they want. This was a pure just excess thing. It wasn't a thing that was needed. So when we talk about ego, it was probably that point of starting the land investing business, but then it switched to survival mode. I didn't have it. And so I had an offer to go back to a different railroad I worked at before, and I did really well there. But they said I was going to have to move again. And so me and my wife had the conversation. She said, "I'm not moving anymore. Like, I want to live in Fort Worth. That's why you left them in the first place." We had lived in 7 houses in 8 years. And so that wasn't going to happen. So I kind of fast forward from there, and we are in a situation now where we have a fund, we have a media company, we have a joint venture company, a funding company. Then we have our land business that still runs today that we started at that time. So, I've been in survival mode for all that time. So it didn't really have the opportunity to be ego driven in a project. And so I will say that we got cocky in some as of late, and one in particular. And so we working with Trevor. Trevor's a really good friend of mine. We talk daily. And we bought into a deal here in Bosque County with Walnut Springs. people said it was ready to be subdivided. We took them at their word. It was a guy that worked with his dad that brought us the deal. It was off market, and it already had roads at county specs. All this stuff sounded great. They just needed to dump it because the kid wanted to become a professional golfer. And so we just jumped on it. It was beautiful, high fence, it had Aoudad on it, just beautiful hill country scene. So we didn't do our due diligence as well as we normally do. We bought the property. We all high-fived at the closing table. We're going to make so much money. We're going to do all this. And 2 years later, we just got the okay from the county to subdivide it. Now, that doesn't sound like, it's like, oh, it took you 2 years. Well, a couple good things about it is we got it at 4% interest rate. It's a $2.5 million property at 4% interest rate. We put our 20% down. So we've been carrying the note, but interest rates went through the roof during that time. So we could have lost a lot more money, which was fine. And then the state laws in Texas changed a little bit to help us out. So we're able to salvage this deal, and it's still going to make really good money. But it's taken us a little bit longer. And so when you talk ego, survival. So I'm trying to go through this to get to this ego point of, hey, you know what? This was probably the closest thing to what you're asking that we've done. And I don't regret doing it because the property's beautiful still. It didn't change the dirt. The dirt's still there. We just had to make the payment on it for, the 2 years, which hasn't been horrible, but it does suck away from your other pieces of business because I think in this deal, I think I have a little over $250,000 in cash in it that could have been turning for a couple more times, but we have 3 partners total in it. And I think we're all in right now at about, I don't know, $800,000 in cash that's just kind of been put into this project that hasn't turned, which we'll get back and it'll work, but it's not as fast as us greedy land investors like to be.
Oh yeah. There's a ton of there on that specific deal and a lot of the points that we'll unpack throughout the entire show. And yeah, Justin, you and I have kind of similar backgrounds of a lot of success hitting an executive position at a really young age and then like kind of moving into the land business. So I understand that the challenges with the approach and everything there. And, part of the reason behind the question is I know y'all's motto at Pasture Holdings is buy the ranch and sell the pasture. And I think that for a lot of people that listen to podcasts and hear about, minor subdivisions or entitlement deals or things like that, they get caught up in the details of like, oh, this is a perfect deal for a minor subdivision. And it's like, well, you can double your money in 30 days just flipping it. Like you don't need to 2.5x your money in 200 days by doing a minor subdivision because you heard Mason, Dan, and Justin talking about how sexy it is to do these types of deals on a podcast or anything like that. So I definitely appreciate your answer there and think that, I feel like this business is, it's so easy to get shiny object, even though you're keeping the product the same. And it's really easy to miss one thing on due diligence because you get so excited with the numbers and the property and everything like that. But that was great. I'll pass it off to Dan really quickly now.
Yeah. So Justin, we wanted to talk a bit about the funds you have raising money, but let's start high level because the reason, or a big part of the reason that there's such an opportunity within the land space is that, as far as I know, nobody has effectively connected institutional grade capital, so 6 to 10% capital at scale to the land business, right? There, again, that I've seen has not been a high level operator who knows the ins and outs of the different moves within land that's been able to connect those two. And so really that's what Mason and I are working to do with our business, our venture ground up partners, and clearly what you're also working on with your fund and your investors. So why do you think that is? Why haven't, just like with storage units or mobile home parks, any of the big money moved in and consolidated the space?
Well, I think it's a couple things. Land's an imperfect product, right? Every piece of property is different. So I could give you on storage, you could say, hey, you need 7 square feet of storage per so many people in so many square miles, and you have basically a I just went blank on the term. I'm sorry about that. An algorithm or God dang, I can't. It's going to drive me insane now. Sorry, but so with it being an imperfect product in land right now, you have so many little nuances on each piece of property that you can't just say, hey, I'm going to do a cookie cutter thing across the board and it's work. So versus like with your storage, you have the ability to do stuff like that. You have to say, hey, I can have this kind of God, man, what is that term? Dan, help me out here. I can't think of the term. A formula. There's a set for. Thank you, Jesus Christ. Sorry, that was a tough one there. I just got off a consulting call. I think my brain's still going consulting with them. So a formula that you can put in place and you can just replicate that across. With land, there's so many different nuances of a piece of property that you have to have somebody look at each one. You can't just say, okay, hey, well, this fits the formula. Let's run it to the bank. The bank looks at the pro forma. It runs and just kind of goes through it. Where land, so like we talked about Bosque, if I look at that piece of property, if I go to the property right next door, it's going to have a totally different characteristic. So to do that at scale with institutional money, they don't understand that there's not an operator that can handle the volume and the nuances that's going to be with each individual property. Now, what you can do is say, hey, I can guarantee a set return for you, and in hopes that they trust you enough that you are able to deliver on that. And the second part of this is if I walk into institutional money and I say, hey, I'm at a home office and I go, hey guys, here's the last 20 projects that we did. These are the returns. And they're seeing 100, 115% cash on cash returns. And then I'm offering them 10%. They're human just like us. And they're like, well, why would I want 10%? You're making 100% cash on cash. Why would I do that? I want 15%. I want 20%. I want half. And so what we've ran into is, as we shop that, because we shop money institutional money across the country, and we've even reached out, some in England, some money, and some money in Iran, and some money overseas. And you run into the idea of, hey, we want to give you all this. We want to give you a huge tranche, but you have to give us half the profit. We want to see what you're doing. And it just doesn't bode well. And then getting that trust right off the bat for a lower interest rates, it's just really tough. And so that's been our biggest problem, is how do I get outside of the land sphere, which we have a decent following there. And those guys are inherently greedy. And I hate to say that, but we are as land investors, because we know it returns. But then secondly, how do we get trust on something that's not done already? If Dan, you asked the question, we talked about storage where I struggled there trying to get the formula word out. But if I go in and say, hey, I'd like to do this with storage buildings, they go, okay, great. They're going to call another storage building expert. He's going to verify the formula that we're showing them. And he's going to say, yeah, that's spot on. And he's going to have somebody else that can verify the data, where in land, you really can't, because those nuances are different and those returns are different. And it's, you hear, I make 130% cash on cash return on everything you touch. They go, oh, that's not true. There's no way that happens. So I don't believe you. And until they actually see it, then it's like, okay, I want more money. So, and it's tough to do that, because we'd all do that in that situation. If Dan, I told you I was going to make $1 million off your $1 million, you don't want 100,000, you want $500,000, because it's what we are. We're greedy entrepreneurs.
Sure. So there's a lot of thoughts, and part of that whole spiel I like, because it really is almost an advertisement for why land is going to continue to be such an opportunity. Those are a lot of the reasons, right? And so for those of us that know it and can get the money for it, there is really a blue ocean just sitting there. But kind of continuing along that point, you mentioned several times about getting low interest rate money from people that don't know the business and just are trusting you. How are you working to build that trust and continually raise money into the 8 figures?
So that's the education piece. So we do a lot of webinars where we talk about the land, and we talk about land and what we're doing with it, how that splits, and it's just continually putting that content out. And that's kind of the drain or the drag in this, is you're educating people on what you're doing, which is great. They have more knowledge to make a better informed decision. But in a return, you're actually having to show how the sausage is made some. And so as you have that group that follows around you, they're like, wait a second, he just said they're doing this. So what I'll see is, it's humorous, and you'll see this as well as y'all continue to grow, is if I say, hey, if I send an offering out in, we'll use Haskell County, Oklahoma, then all of a sudden I start seeing amongst the Facebook groups, and hey, who has a surveyor in Haskell County? Or hey, who has this? Because we've showed you what we bought it for. We showed you what we think it's going to sell for. We showed you what we did. So I showed you how I made the sausage, and now you got your own sausage here. And then take a step further in the education space, is now you have 3 or 4 guys that say, oh, I can show you how to teach you how to do this. Now they're the next big thing, the education piece. It's like, oh, the next guru that's going to show you this, and it's going to show you how to make all millions of dollars in 1 month. And it becomes almost, if you think about the gold rush back in the day, you had all these people that were going to mine for gold, and they got cutthroat, at the bar, and you're having a conversation, and they start having gunfights and knife fights and all this. And so, I said this at the live event that Mason and myself sat next to each other, was, we're all wildcatters. We all are. While we typically share information a little bit more than you would typically see in a in a fend for yourself type environment, at the end of the day, we are wildcatters. We are all going out to try to get an opportunity to cash flow off of that or profit off of that. We are trying to look at a different way in the problem, saying, hey, there's not enough cash here in the land business, so how can we go get cheaper money and make better deals and scale even bigger? We're looking at it from a different way than other people, but still everybody's trying to fend for themselves as a wildcat investor. So because we're not institutionalized yet.
Oh, yeah. That's great. And I think it resonates with Dan and I a lot, where cutting our teeth in this business, we've dealt with those people within the land investing space of, hey, I'll partner with you on a deal, or I'll fund your deal for 50 to 60% of the profit. And we've done that. And I've taken those deals because at the beginning of it, whenever you're cutting your teeth, you have to. And I think this right here is the problem that we're working to solve, because you're talking about the education piece of, between the three of us on podcasts we've guested on and podcasts we've put out, thousands of episodes, give or take. And people learn about it and learn how to make the sausage, and it's really, really enticing. And I feel like within the entrepreneurial space, that's why Dan and I never approach these entrepreneur type people to raise money anymore, because they say, okay, yeah, I'll do it for a 50% cash on cash return. It's like, okay, well, we just today got a subscription packet for our fund at, we offer 9% annualized or 5%, 9% annualized with a 2-year commitment, 11% annualized with a 5-year commitment. And the guy that gave us this money was, he's a finance professor. He recognizes 9 and 11%. Those are fantastic returns. They really, really are fantastic returns. And it's bridging the gap between the finance professors and the physicians and the attorneys and connecting them with people like you, but also recognizing that they're not going to go out and start a land business, because I don't think any of us are really worried about the competition. You mentioned the gold rush. I think, within this space, there's a reason people get into education. It's because, who's making the most in the gold rush? It's the people, selling the shovels and the pickaxes rather than the people actually mining for gold. And that's why so many of these people switch to education. But talking, specifically about kind of investor avatar, who is your favorite, and you don't have to name names or anything, who is your favorite person or ultra high net worth individual or office or group that has invested in your fund or invested in your business that you've gotten to work with?
So we've had two. So
and make it like a typecast, I guess, maybe.
Yeah. No, I understand exactly what you're saying when you say the investor avatar. So there's two different types here. We have our note fund, which is it pays 11% and it's 9 months lockup period, but it's 11% annualized. And these are cash flowing assets that we've bought either the note or we've generated the note through Subdivides, and where we offer owner financing. So in their first lien position, typically unpaid balances are 65 cents on a dollar. So they've got a ton of equity in it. They're cash flowing, they're performing. Worst thing that we like to say, the worst thing a person can do is make their payment on time. And because if they don't, we sell the property, foreclose, we sell it, we've made 40% or 40% profit right there. But that's the worst thing they can do is make their payment on time. That avatar, what we've seen is foreign money. And the reason that is because of interest income and the way they're taxed overseas is different than the way me and you would get taxed. And we get taxed as ordinary income or capital gains, depending on where we're at. A person overseas gets a tax. They don't have to pay taxes on the interest credit. So they actually receive more money than they would, investing in something else here where they're getting equity. And so that avatar has been really good for us, where we've seen high worth attorneys that are in Dubai or, France citizens where they can invest with us and they get the true 11% return because it's interest income to them. And so it's forced, I think it's the foreign interest income tax loophole or something like that. So that's been a great avatar. The avatar that I really like here, and you alluded to doctors, but is the professional that is 55 and older, that wants to be part of the gang, if you will, like still kind of wants to be one of the guys, but he understands that he's not going to set up a whole shop to do this. And he's done well in his professional career, whether it was a doctor, which we have some, maybe chemical engineer, maybe accounting, and they recognize that, hey, these returns are crazy. Because our offerings with our Subdivides are a pref, which is a 10 pref, 10 to 15 pref, and then they get an equity kicker on the backside. So they've got skin in the game on the back end. So they're getting to run with the boys, right? They're getting that piss and vinegar they still want, but it's still a great return. Where our 2 full cycle deals have gone 61 days on average with an 18.6 cash on cash return. So 61 days, 18.6 cash on cash return. That's great. You annualize that out, it's up over 100%. So you're like going, wow, that's insane annualized return. So it's the problem with that is it's so quick, those first two that went full cycle, that they're like, is everything going to be like this? And we know for our data, that 150 days right now, 180 days is typically what it's going to take to turn. But we're in a flux right now in the market, and I don't know if you are seeing that or not, but it's just you don't want to get somebody hooked on the good fast returns and them not understanding, hey, you need to plan for 2 years on this stuff. So that's kind of where we're trying to battle that education piece. So the avatar is important with that he knows, hey, 20% is great, but he also understands that, hey, if we're beating the S&P, then I'm doing good too.
Oh, absolutely. Yeah, I think it's ironic too, where I'll have investors that are established with me. It's always these really quick deals that turn around in like 3 weeks. Yeah. And then I bring a new investor onto the business and it ends up taking a year and a half. And all the data I show, I'm like, look, and then you feel bad, and it just is what it is. And that's why, effective debt structuring is so important. I have 2 follow-up questions to that. So with that foreign investment, interest only, walk me through a little bit more, like the actual specifics of that. Is it just like a note and deed of trust through them? Is this a debt fund that they're investing into and they're getting payment on, or how does that actually work on that?
It is a debt fund where we hold the notes, but the way ours is structured with the K1, it's going to come back as interest income to them. So they won't see it as equity or that piece. So that interest income piece is important, how the K1 goes back to them. Now, I'm not a CPA. This is just, we went through our CPA when they asked. The guy it's educational to me a lot of times, because the guy that reached out to us that really turned us on to this was, he's an attorney in Dubai, and he goes, hey, how is this going to come back to me on my K1? And so I was like, it should be interest income, because he's like, okay, great, because he's a U.S. citizen living there, but his wife is a citizen of another country. So we put it in her name to where that interest income comes back. And so we just make sure the K1 has the interest income going back to them. So that foreign.
Interesting.
Yeah. So we talk about how can you turn land into a tax play, because typically it's not. This does for that person. So it worked out well for them in their situation. And everybody's situation is a little bit different.
Interesting.
This is one of the things that we noticed. So.
Yeah. Because I mean, in my mind, it's, it's distinguishing between the K1 or versus like a 1099 INT, depending on like how you set up the structure of the deal with a note or that sort of thing. But that's interesting. That's getting my brain worrying in a way that I'll go research it off the podcast. That's really exciting stuff. But on the flip side of the first question I asked you there of, who's your ideal investor avatar? Who's your worst avatar that has invested? Who's the person you don't like working with?
No, we've had a really strong following. And so the group that we've worked with, and here's a fun fact, I say a fun question that was brought to me. So a little history about me is one of my really good friends, he managed a home office, and he was given $1 billion and told him he needed to double it. And so this is back 2017, 2018. Family was real big in sand, oil and gas. And so then he kind of became a corporate raider, and he would buy people's debt at, whatever cents on a dollar, then sell it at this cents on a dollar, because he'd sit on a board and they would know who he was. Then he took over in the state of Alaska as one of their investment officers for the state. And then now he's in the private sector again. But he asked me a question. He said, when I said, hey, he came in town, his mom had surgery. We went and visited her. She wanted all the kids to come play a game with him. So we all played like Scrabble and whatnot with her, just to give her some company. But he asked me, he goes, how many of your people will reinvest with you? And that was an important question for us, was because that shows the trust that your investors have. Because in his mind is, you don't need a lot of investors. You just need investors that trust you and continue to put their money with you and keep them with you. And so that was a question he asked. So when you ask who is an investor I don't like working with, I haven't met that person yet. Now I don't like working with people that have a high expectation of high returns in 20 days, because we set out the deal disclosure memo and it says, hey, you're gonna have your money tied up for 2 years and this is what we think. I want you to kind of take that as what we think is going to happen. I'm ultra conservative in my underwriting. Now, if you said, hey, well, Justin, you did the last 2 deals, average cycle time was 61 days. Why isn't this one done 60 days? And that's the person that's calling me, blowing me up. Well, I told you 2 years on this deal. But luckily for us, we haven't had that issue come up yet because people have begun to trust us, and we have so many your return investors that it's been really crazy. So the last offering we did a live launch on it, and it filled up in 2 minutes. And the one before that was an email launch, and it filled up in 10 minutes. So it's really exciting to me when I'm going through the pitch deck, and we said at the beginning, hey, we're opening up the offering right now. Ask any questions you have, fill up, and you're going through, and you don't even get through the second slide, and it's already filled. That's a testament to the trust that the investors have in what we're seeing. And again, we're doing it live because we want the live feedback. We want to have the education piece, because it's easy to take a land investor that's done a couple simple subdivides to say, hey, we're taking this 76 acres and we're going to split it into 7 10s, right? It's easy to talk to them about that. But the person that hasn't been a part of that yet or doesn't understand it, you want them to get some of that education too, so we can grow that. So I know that kind of segues out of your answer there, but because I haven't met that person yet, but ideally I don't want to meet the person that's expecting 60 days, because that's what we did on the last two. He understands our deal disclosure memo is 2 years. That's what we're expecting.
Gotcha.
Yeah, I like that. So under promise and over deliver, it sounds like has worked quite well for you. So kind of to that point, one more question I wanted to ask on the fund, and then we have some on more of the actual tactical side of your business. Going back, if you were restarting your first fund for the first time, is there anything else you would do differently, or mistakes made that you're kind of kicking yourself or making sure you never make again? Anything like that comes to mind?
Yeah, there's two. I wouldn't do it again. And I say that so that's the first thing, is just because it's added a second job, right? We talk about being wildcatters, entrepreneurs, and being investors. And so I'm a tactical operator by trade. Like I want to be involved. I want to get to know it. I didn't know fun stuff. I didn't know what I didn't know. But when we talk about education, that's a long game play, right? That's not a make money right now off that. Then you're showing everybody how the sausage is made so you can educate them. So you're giving away a piece of your business, and you think, oh no, Justin, that's abundance mindset. That's what the gurus tell us. We give away or get back. But it's the amount of marketing that has to go into it, the compliance that has to go into it. Now we're shopping either institutional side and the individual investor. So you have multiple pieces there. So not only am I having to still find the same deals I was doing, do the deal, I'm having to find the money and that whole other side of the business and coming into it. So it was more of a job than I really think that any of us as partners were really wanting to get into, because now you have 3 partners. We have myself and 3 others, and we all can operate at a very high frequency. We all work together really well, but we all 4 don't work in corporate America because we don't want to have a job. But now I have standard calls to keep minutes in place. I have standardized calls with the marketing department to make sure that they're running their marketing stuff. I have investors I've got to reach out to because we're constantly having the funnel fill up with investors. So you have all these other things that go on. So I say that I wouldn't do it again. I don't know that I could, to do it right, I don't know that I could do it any other way. And so I probably wouldn't do it. I would do something different than build the fund and create a 40-hour-a-week job for myself. And then second piece, and I know that's kind of Debbie Downer, and I hate to say it because the fund has been great. The people we've met have been great. It's done well. It's just that didn't want to sign up for another job. The second piece is attorneys. Every attorney has their own opinion, and you put 2 attorneys together thinking you're protecting yourself, and then you get a 3-week conversation over, 30 billable hours over a couple of words and how they're phrased. And that's where you talked about ego earlier. You really want to talk about ego. 2 attorneys talking to each other. Boy, that is not good. And you're like, you had to jump in and say, hey guys, what do we need to do to just do it? And then how do we protect ourselves? I don't care about the they, there are, who, what, when. Can I do this? Yes or no? If I can't, how can I do it? And they're like, well, and every attorney always tells you, well, it depends. I don't care about the depends. Just, I'm going to do this. And can you protect me if I did that? Well, yes, but I think the best way to do it is this way. Perfect. That's the way I'm going to do it. You got my back if I do something wrong. And so that was we hired an attorney through the software we used, which was, he did really good. He's boilerplated everything. And then we hired a secondary attorney that we brought in, and he was just kind of checking the work. Well, he wanted to prove his worth, and so he's going through redlining everything. Come on, man. What should have taken a week took 6 weeks. And so that I wouldn't get multiple attorneys involved. It's okay to ask for a second opinion, but having two trying to battle out what that is, that was kind of a slow woe. And that was the real eye opener right off the bat. It's like, shit, maybe we got into something a little bit out of our depth.
Yeah, we get that of nothing like getting a $750 invoice for replacing one word on one document because we caught something in the operating agreement that was not correct, and we're like, okay, well, Control F, we could have replaced it ourselves and saved nearly $1,000 on that one thing right there. But
yeah.
I'm looking at your team on your website, and I noticed that there's not a vice president of investor relations or anything like that. So is it you and the other people on the team that also manage all investor relations too?
So Beth is amazing. She's loaded as general manager, and she's kind of the glue that keeps us all together. Josh runs operations a lot. Trevor does the marketing. He's out swinging at the big. He's swinging the bat for the home runs, and then doing some new onboarding with investors. Beth kind of handles the investor, the portal, the making sure the money's to them, and then I'm kind of the backup amongst all of them. So I run kind of behind all of them if needed. And then I'll step into like interviews like this, kind of guide where we think we need to guide, and just kind of make sure that it all mixes together. And then I'm best support, if that makes any sense, because she'll talk to an investor, then investor will ask some questions. She's like, hey, we reach back in to talk to them. So she handles kind of first level, then I kind of support her in whatever she needs, like the accounting, the marketing, all that stuff. I involved in all of that, but she is our go-to with the investors. When it comes to the personal investor, Trevor handles the kind of institutional side, trying to bring that in and bringing in deals. Kind of Josh, myself, and Trevor all look at deals and bring them in together. But it's just kind of a cohort mixture of where the role is, and I just kind of try to fill in and help anybody that I can. And then Beth is, like I said, is that point person.
Makes sense.
So to your point about you wouldn't start the fund, going back, how would you be structuring things given that? Would you just be waiting until you have enough of your own cash to play with and do everything that way? Would you be doing deal by deal arbitrage or raising money for a deal? What would you do?
So I guess from where I'm at in my investing, there hasn't been a deal yet that I wouldn't be able to do on my own or with, internally in our group. So it wasn't a need for money. When I say that sounds egotistical, and I don't want it to come across that way. It wasn't a need that I need money to do deals, because that wasn't my bottleneck. The idea is how do we get cheaper, faster money? So we have established banking relationships, and so some of these deals that we're personal guaranteeing with the bank, it doesn't matter. The fund's not behind it. It's me or I say me, when I say that, I mean my team, where we personally guaranteed these notes. So we could do those out this side of that. But the idea or the long game of it was, how do I put together a pool of investors or money that is quick to go to without a guarantee against it towards a bank? I don't want to have to deal with the banking regulations. I don't mind dealing with the SEC and saying, hey, this is what we're doing. This is how we're doing it. This is what we expect a return to be. And we're working with individuals that see that and are good with it. So it allows me to have a bank at my fingertips without all the banking stuff, if that makes sense. So that's kind of the idea behind the fund. Then the second piece of that is, if we put together this model and we can do it, as your first question you asked, Dan, was how does somebody do it at scale? If we can fix that problem, what is that solution worth? And when we originally broached this, they were told us it was worth $50 million. And so the idea was like, can we put it together in a way that we could package it up as a $50 million exit in 5 years? And that to me sounds romantic. It sounds kind of like it gave me a little spark again. It kind of made me teary-eyed when I heard that, like, oh, wow, what we're doing is really worth some money. Now, whether that really happens, I working towards it like it will, but I don't know yet. I'm still kind of chasing that dream right now. And so whatever that looks like, I hope that answers the question. It wasn't a need that, hey, I needed access to $50,000 when I needed it. It wasn't that. It was more of a, hey, the bank's going to lend me up to $9 million on my personal guarantee under my name. One bank will. but I don't want to deal with the bank all the time and have to, fill out all this stuff. I want to be able to go to a group of like-minded people, even if I'm paying a point or two more, and have access to that cash pretty quickly, and make some other people some money along the way.
Sure. No, that all makes sense. But let's transition into the more tactical day-to-day of what you're actually doing, what your specific strategy is. So, talking with Trevor, looking at your website, is everything you guys are doing taking these large ranches in Texas and splitting them up into still large but smaller tracts of land for recreational hunting, or to build, kind of an estate on? What does the model look like? Is it all subdivides? Speak to that a little bit.
Yeah. So with Pasture Holdings, I'm going to speak Pasture Holdings versus my own personal land business. Pasture Holdings is all have been forced appreciation plays or the note portfolio. So we have bought and sold 20 something notes, I think 20-ish notes, 25 notes. We have an institutional investor on the backside of that they look at every one of our products that we take on a note side. I'm going to talk note side first. We try to buy to 18 to 22% yield. Then we turn around after 3 months of seasoning with us. We send it to them to get an offer from them to see what it pays us and see if there's a slight arbitrage there. At which point we can use the same $500,000 tranche, and we can measure it to keep buying notes and keep putting them in because we're cycling them in and out, where we make a quick hit, kind of like banks do, just the banking model of selling mortgages, getting some of your money up front, and they're making money. They're buying it at 15% yield. So we have a 3 to 5% arbitrage, which, works out to about a 15 to 20% return really quickly on a note side. Now, the Subdivide side, we have taken, everyone has been a split. We've done 40 acres, 60, 156, which is on the market now in Comanche, Texas. We have a Haskell 70, which is a split, so they're ranging from the biggest that we've cut down to is a 40 acre. But typically we've been buying in that sub $500,000 range. We've got up to $1 million where we buy it, split it up inside the fund. And we're doing that because right now the market on stuff over $300,000 is kind of down. It's not moving what it was 2 years ago. So we're looking for opportunities that we can cut the product down to sub 150. We can offer owner financing with 20% down, 10.9% interest at 15 to 20 years. We can do some balloon stuff in there to help the amortization schedule, to help the return. But that's kind of the model right now, is get what we can for, sub $1 million that we can cut up into $150,000 or less product, where we're forcing appreciation at 30 to 40% over that if there's leverage involved. But we try to shoot somewhere between a 70 to 110 cash on cash return. Now it changes, like, so inside of our personal land business, if we see something we're going to force 200, 300% cash on cash return, it typically doesn't go to the fund because we'd be giving away too much money at that point. But we do look for that 70 to 120 range, is where 120 is typically where I won't do it on my own. And then that fund money, we can pay them, use other people's money, arbitrage the difference there for the fund. But yeah, it's creating that sub $1 million ranch right now and bringing it down to that $150,000, $125,000 product.
Mm. Justin, that sounds like a formula to me. How accurate do you feel like you're getting with that formulaic approach? Because if you're attempting, I don't think it's a pie in the sky, but I think what you're doing is you're working to build this $50 million-ish exit on this business. How repeatable do you feel like this formula is, dependent or not dependent on, more macroeconomic cycles that are going on? How repeatable is it beyond Texas, in other states? Do you need localized teams to deal with all the different city and county regulations? How do you picture this moving to 50 million? And if it's just within Texas at 50 million, what would it be if it was nationwide or within, 10 to 20 different states that are favorable for this type of, deal structuring?
So that's a great question. I will say that the misconception a lot of people have for us with Pasture Holdings is it's only in Texas. Haskell, Oklahoma is one and done. I personally bought and sold in 44 states now. Part of the Subdivide masterclass that we did with Casual Fridays, and with Trevor was part of it as well. We kind of put our brands together and put that together. was to put operators in other states. So we put 21 people out there that have been done to do this. But as you know, anytime you start with one thing, you have to kind of build those steps up. So going into a fund model, what does that look like, and how do you fund other people's deals? Well, if I've got 21 operators out there running, doing subdivides now that I've personally trained, and now they're going to have a need for cheap money, it's creating the solution before you create the problem. Now I've got guys that can do this in 21 states. Now I just got to find them the money. Now, what does that look like from a regulatory standpoint to provide that money for them, if they want to use us or not? And how do we maximize those returns? So there was kind of I'd say, for lack of a better term, we played chess with this. Okay, hey, let's get these people trained. They're doing this across us. So now I've got operators in all these states. Now can I provide to fix their problem, which is always money. You know, as you scale, it's always, how do I get more money? How do I get it faster? How do I get cheaper? So it's not about a Justin or Trevor or Josh or Beth. What can we do? It's what can the guys that we've trained do, and how can we fix it, make their job easier, and then take down other products. But to get to that point is I have to understand what I'm allowed to do, regulatory, and how do I make it work, and can I put a trust factor against our brand and the operators that we're in place, and then slowly add in these guys that we see doing these deals across, you know, the different states. So, you know, if I'm trying to beat a 30% cash on cash return, and I've got a guy in Mississippi that he's doing 150, 200% return, and I say, hey man, bring us in on 40%, we'll let you operate. Now he doesn't have to go to a bank, he doesn't have to call a rich uncle, he doesn't have to call anybody but us, and we have that solution for him, and then everybody down the line takes place. We've started that early on, and getting them out there, getting their feet on the ground.
That's great. And I think that right there is where the education component really comes in, of we want to teach people how to be effective operators so you can bring us deals and we'll fund them and partner with them and help you manage them, type of thing. Is, you know, the whole idea behind what Ben and I have created, and it sounds like what you guys are creating. Yeah.
So it's a great point. We talked about earlier, the only person that gets rich in a gold rush is the guy selling a tool, right? And so many people are selling like some kind of technological tool, because it's easy to replicate once you've got it dialed in, whether it's a CRM or whatever. I have been very open that the only reason we did Casual Fridays when we started the podcast in 2019 and had our course with that was to partner with people on deals from Plum. Plum, we started in 2018. We were the first company that said, hey, I will give you money on your deal. I want 50% of the profit, just based on a deal. I don't care if I've never met you before. Just send me the deal. If it works, we put it in our name. We'll give you the money. You sell it, and we split. And so we started that in 2018. There were people that were doing it quietly, but nobody would step into the limelight in the internet guru land space and say, hey, I would do it based on a deal. And now there's 150 people, 200 people that'll do that. But that was why we started doing that with the education, was saying, hey, we called it bass boat properties, and the cost of a bass boat, like $50,000, $60,000 properties, you're buying for a third of what they were worth. But the idea is, hey, I'll teach you how to do this, but you're not going to have the money to spend. Most people don't have 10 or 20 or 30 grand. I'll put up to 10, 20 or 30 grand and we'll split the profit. And so that's what started that, is like, I'm creating the funnel to feed my funding business. And so now as we get into the thing, you start to do that and you continue to do it. And I've never been shy about that. Now, it wasn't to feed you into a CRM. I don't sell you a CRM. It wasn't to hook you on affiliate links. You know, those are great, whatever. But it was, the idea is, how do I train somebody to look at these deals? Because I can only look at so many deals at one time. I can only get so many jammed into it. But if I have 50 or 100 people looking at deals that I'm willing to get money to, because I don't care who you are, I just want to look at the deal. And now you're sending me, you know, it has road access. You know, it's not in a flood zone. You know, it's at 50 cents on a dollar or less. Now I have a very qualified lead with somebody else that's already pre-done it that I didn't have on the payroll. And so they're doing all the pre-work, and I'm able to scale and do more deals faster than I would be without that. So there's no secret to that. It's just that's kind of what we followed.
Yeah. That's a copy and paste of our funding business right there. Of, we want people to, it's an extension of our acquisition arm, essentially, nationwide. Of, there's so many markets that we're doing deals in that we would have never done deals in, not because of it's a bad market, of you can't operate in every market in the country. But kind of on all this point, do you see yourself bringing legal in-house?
Ooh. So we keep, hey, man, you said that I started to think about all the attorneys I have on retainer. I have a local attorney that's kind of my quick rush to, that I say, hey, I can call and text him and he texts me right back. I do have a attorney that's a big litigation firm that's ready to go at all times. In Oklahoma, since I do a lot of deals in Oklahoma, I've got an attorney there that I run everything through. He does like my quiet titles, all my foreclosures if I need to, anything that has to do with the Bureau of Indian Affairs. So he's on retainer. So I don't know that I'll keep like an attorney that's in office with me. It just doesn't fit what I have, but I keep attorneys on retainer that are in the markets that I'm real heavy in. And then like with the fund side, we have the attorney that set it all up. He just charges us hourly when we reach out to him, and it's quick return. So it just kind of, I don't know that I would get back into, like I said, having an attorney that's just he hangs his tile in my office, or a shingle, I guess is what they call it, a shingle. But we wouldn't keep anybody here.
Yeah, makes sense. I know with all those different attorneys on retainer and everything, you start adding up what your annual legal spend is, and you're like, if I could have a jack of all trades attorney in house for $250,000 a year, that's the dream. But sometimes it's not feasible with how many markets you're in. And
but you talk about specialization though. The attorney does not going to be specialized in everything you do, and so they're going to have to bring in somebody else. So like my local attorney, I called him the other day. I haven't ever dealt with this with a bankruptcy in Texas, but bankruptcy's federal. He's a Texas attorney. He's like, hey, it's federal. Well, I haven't dealt with it in a way that the guy wants to reaffirm the debt with me, meaning he doesn't want me to dispel it. He wants to keep the property. He wants to do everything he can because he's living on it. But so I reached out to my attorney. He goes, I'm not the person for that. He goes, this is the guy I use for that. And so just having him on a retainer, he puts me into that conflict. Doesn't charge me anything. He just says, hey, you're one of my clients. This is a guy. He makes the introduction. That guy goes, yeah, this is what we need to do. This is what we'll do. We need to fill out this, and this. Give me this paperwork, and I'll charge you when it's done. And so, it's just something that you have there. And we have a deal that we're doing in Oklahoma that was title was quieted back in like the 80s, but the Bureau of Indian Affairs never signed off with somebody there. So my attorney there had to go to the courts and do a quiet title again, and then go to the Bureau of Indian Affairs and say, hey, are we good to release this property? And so there's, especially my attorney in Texas, that's my local guy, he would know nothing about that. And so it would just be a waste of money for me, in my opinion. Now, if we were doing more legal stuff, it might make sense to bring a paralegal in and then have her run through an attorney that we work through. But for the way it's set up, I think this is the best for us right now.
Sure. Yeah, it's always tricky knowing when to bring someone in-house versus continually outsourcing it. Quick tip there, if you can find a title company with in-house attorneys, or of course, if you're an attorney state, I have gotten a lot of free legal advice and very, very cheap work on contracts and that sort of thing by just giving a lot of contracts, using the escrow company and then the in-house attorneys. If they like you, you can get a lot of help there for free or very minimal cost. So that's been really useful, especially in Florida. My title company has an attorney, and that's been awesome. That we can say something.
That's for a lot of people, that if you go through some problem title properties, work with an attorney, pay the money up front, the education and the return on investment, that is huge. For us, we got really good at cleaning title up in Oklahoma, and it has paid dividends for us because I hired an attorney. They walked me through everything with it. And so now I can look at title. I can run their deed of the chain of title and have an idea of what's going to need to be fixed and how much it's going to cost me. And I can adjust my offerings that way. But, the first time I did it, it cost me $2,600. That $2,600 investment into that attorney for that one quiet title has probably made close to $1 million back, and just fixing problem properties that most people would say, I can't touch it. And state to state, they're different, but it's kind of close. And so you can ask the question, say, okay, hey, in Arkansas, you may be in Oklahoma, you do something in Arkansas and say, hey, this is what we did in Oklahoma. What's the difference? And their attorney goes, oh yeah, well, we're going to do this a little different. We need this person to sign here. That's all we have to do. And it's not as much money. But now not only did it pay dividends in Oklahoma, but it paid dividends in Arkansas. Then you come to Texas and say, hey, this is what I did there. And they go, oh yeah, we're going to do an affidavit of airship here, and we can clean the title up here. And so you start moving that around, and it really pays for you to actually understand how to fix those problem properties. And it's money well spent.
Yeah, paying to get that initial competency. A lot of times it does carry over, but moving forward, and we're getting close to wrapping up here. We wanted to ask, have you done any vertical construction with any of your projects, or have you always sold beforehand?
So I've always sold beforehand. Now that doesn't mean I wouldn't do it and I couldn't do it. I typically the velocity is there for it. Now, what we have started doing over the last couple of years, and if you followed kind of my journey with Casual Projects at all, we talked about buying a tractor and putting it to work. So in 22, I implemented having a tractor on staff, and he goes to every property, touches it. He makes sure I can drive onto the property. He has a mulcher, cleans up the property in the front. He runs path of less resistance in to cut trails into the property. So when somebody comes out to a property that they're buying from us, they can drive onto the property with the realtor, open their door, and they're not hitting any brush, anything. So it's made the experience a lot better for the end user, which has allowed for a faster sales cycle, which has allowed for a little bit more money. And it's been another way for a tax play for me because I bought a tractor. That's equipment. He's using it, and then his company rents it back from me. And so for every hour, it's $125 an hour. Every hour he gets paid $50 an hour, and they pay me $75 an hour to lease my tractor. And so the tractor cash flows itself. So again, we talked about deals inside of the deal. Where can I make money? What can I do? I can hire a guy, find a guy local to the deal, or I can shop and market within 200 miles of him, pay him the mileage to go out. He cleans up my property. He's there the day I close or the day after I close. And I know what I'm getting, how I'm getting it versus having to find somebody, get a quote, make sure that's right, get them back out there. And so it speeds up the whole sales cycle.
Yeah. Oh, that's smart. I think that's worth thinking about and seeing how you can apply in your own business. But I guess one of the last questions I had was, what's the long-term goal for you here? You mentioned the bigger picture, the $50 million picture. Are you, buying apartments on the side or putting your money elsewhere? What's the long-term look like? Is it a larger exit of a huge portfolio of notes, or where do you want to take this in 5, 10, 20 years?
So for me, I don't know y'all's ages. So I'm going to speak from a guy that's 42 that has 3 kids, his youngest kid being 6. I can't do anything. As my responsibility as a father is to make sure my kids have the childhood that they deserve, not me chasing dreams of going to live on the beach and going to do all this. And so I've committed to myself for my kids is that I want my youngest to get into college before we do anything big with life, like, go live on the beach somewhere. So for me, there's not a goal that's like, okay, once I make $5 million or my net worth $5 million, or my net worth $10 million, I have this, that I'm quitting, because what am I going to do? I'm just going to sit at home. We are Wildcatters. I don't have a job per se. I come to the office from 10 to 4, but if I want to go have lunch with my kids or go see their sporting event, I can do that. So there's more of a lifestyle that I want to leave for my kids. And then at that point, I'll decide where I want to go with that. Now, that's kind of the woo-woo answer of, I want to be a good dad. I want to be present. I want to have this lifestyle with my wife and my kids. And so it is true. It was 100% true. Internally inside the business, I'm pushing myself in different areas. Like I want to build some warehouses and some flex space stuff that creates a cash flow that can be generational. What we're doing right now, we just got greenlit in the city of Burleson. So now we're going to engineered site plans to them on 115 unit car flex space condominium. You see like luxury lockers is a name out there. So it's they're flex space warehouses and oversized luxury storage. So for your nice RV, your nice boat. So you're talking 15 by 50 feet, 16 by 60 feet with a 27-foot roof and a mezzanine, or 22 by 75 foot. So we're working through that right now. That's been a project I've been trying to get done for a couple years, because I think that flex space is a good way to get into the industrial side or commercial side without the worry of big tenant delay. The way we're doing this project is we're going to be offering to sell, and then we will keep some of the profit in stuff that we hold for the rentals. I do put in any subdivide. I do have to subdivide. Up until lately, has been going into apartment syndications, and so that creates some cash flow with, for the long term and tax play, and I continue to roll that. And then we've been buying a lot of mortgages over the last 2 years, land notes, mortgages. So combined between me and another partner with the fund and everything, we think we bought close to $4 million in mortgages. Again, when I set up my mortgages that I create, I set them up at 15 years. Remember I said my youngest is 6, 12 years gets me to him 18, 15 gets him out at college. And so that's kind of my target is how do I create cash flow and wealth for the next 15? And then for minimum, and then what does that look like if that creation of wealth happened during that time? And I can sit back and kind of look at, what life provided for me. And so that's kind of what my target is. Now, what does that say? Hey, I'm going to buy a bunch of apartment complex, buy a bunch of warehouses, buy a bunch of mortgages. It's going to be a mix of all. But I continually flip land. We run the land business and we run the other pieces as well.
That's great. Justin, what is the most important lesson you feel like you have taught your kids or are attempting to teach your kids?
Ooh, that's a good one. So a couple things that I see very common across the parents is that they give the kids everything they couldn't have. Meaning like they wanted the Nikes, so they got the kids the Nikes. They wanted the name brand everything. We don't do that for our kids. Which we really moved away from buying them stuff, meaning like having a bunch of toys. Like how many kids you get? Do y'all have kids? And then correct. Do y'all have kids? Either one of y'all, Dan?
Not yet.
So when y'all have kids one day, your grandparents are going to show up and hand them a bunch of presents on their birthday. And it's going to be the cheapest toys they thought the kids would like. And it's just going to be a bag of shit. And so we tell our parents is that we don't want stuff for our kids. And that doesn't mean they don't have toys. They have plenty of toys, but we want adventures for them. We want them to go on to Mexico with us. We want them to go on these short trips, it's whitewater rafting, or if it's go camping or do these things, because it's a proven fact that kids don't remember the toy, but they remember the time they did this thing with mom and dad. And so we have really pushed the idea of adventures. So for their birthday, they just had their birthdays. Hey, what do y'all want to do for your adventure? Like, what does that look like? And so we get to spend time with the kid. They build this core memory, because I heard this quote that we are the ghost of your kid's future as a parent. That's what you are. You're going to be that ghost to them one day. And so we have to provide good memories for that ghost to be something that's internal for them. And we only get them for so many summers. As my youngest is 6, he's just at the age now where he can go have fun with us. So, and I've got 12 more years before he's gone. So I've got 12 summers, I've got 12 winters. And so what can I do during those times to really increase that? And so I hope I'm in putting in the fact of what a good parent should do in those adventures and these ideas and dreams versus the, hey, you can get Nikes, you can get this, and then not be a good functional human. I want him to be a good human. And we talk about investing. My kid got bullied on a bus because he was talking about investing in crypto. And his friends are like, my dad says crypto's a scam. And I was like, yeah, his dad doesn't have anything to show for his life. He lives paycheck to paycheck, and so we have those type conversations of what that looks like. My kids all have a net worth over $100,000, and my two oldest, they're 11. And so how do you get there? Well, you start talking to them about investing and trading and doing things like this, but I'm putting that money towards them. They get paid from the company, right? And so I ask them, and this is how I treat them is, hey, you're going to do this chore for me. You can have $10 right now, or I'll put 20 in your savings account or 20 in crypto for you. And, my son's always like, heck yeah, give me double. I don't need the money. I got $100 in my piggy bank. My daughter's like, oh, can I have it at Starbucks gift cards? She's like, no, we're not going to Starbucks. It's crap. We're not doing that. So, two different kids the same way, but having those type of conversations and letting them know that you can build something without actually having to really build it early. But then also the adventure piece too, and not stuff. So kind of a big brain dump in there for you.
No, that's great. I think valuing experience over material is fantastic, and then teaching them long-term investing strategy. It's like you're doing the marshmallow experiment at home, basically. Of do you want one marshmallow now, or do you want 2 marshmallows in 30 minutes? And you probably get to see the age where their mindset starts shifting more of that instant gratification. And I think that's really great advice for parents or soon-to-be parents. So anyone listening, feel free to send Justin drum sets, really loud, obnoxious toys, because it sounds like he doesn't buy his kids toys.
I will donate them. Some kids somewhere else.
Right. So as we wrap up, are there any questions that we did not ask you that you wish we had asked you?
No, I think y'all did it, and we kind of bounced around the fact, and y'all said it as well. There's not one way to do this, and so your fund's going to be different the way my fund looks. My experience with different properties, and you talked about, don't get stuck on the shiny object. I was talking to somebody on a consulting call right before this, and this guy's a proven business operator, but he didn't realize his business was a funnel. And there's another piece to this. Inside your funnel at the bottom, you get all these people that come into you, or the deals that come into you. You have to decide where you put them. And it's okay. They can fit in multiple spots, meaning if I bring a 40-acre property and I can look at the quick flip, or I can say, hey, what does it look like if I cut it in half and operate that away? What does it look like if I have owner finance? And you have to start sorting inside your business, but it's okay for things to have multiple tags against it and really look at what's increasing the value of your company, whether that's the enterprise value, whether that's the velocity of the deal, with you getting cheaper money or whatever that looks like. So just look at the side of your business and have those type conversations with yourself, because there's not just one way to do this. It doesn't mean you're chasing off some shiny object, but there's multiple ways to layer inside your business.
There you go. There's more than one way to skin a cat. Justin, where can people find out more about you?
They can find us at pastureholdings.com. You can email me at justin@pastureholdings.com, or you can hit any one of the 6 damn company social medias I have with Casual Fridays, J_J_Sliva on Instagram, or Land Mule, or Land Couple, or wherever. You can find me on all of that stuff.
Fantastic. We'll make sure to put all your links in the show notes. Justin, it was an absolute pleasure having you on the show. And this was a great conversation, super beneficial for us. That's one of our favorite things about the podcast, is we get to get our questions selfishly answered for less than it costs attorneys. So this is Mason McDonald and Dan Haberkost with the Big Picture Blueprint, signing off.